Hey, everybody. Welcome. Welcome. We have another Sunday edition of This Week in Climate Startups for you. Get your coffee, snuggle into your bathrobe. Today, I sit down with Taj Eldridge. Get a bagel if you want. I sit down with, if you're doing the carb thing, Taj Eldridge of Include Ventures recently raised $250 million to invest in, so pretty big fund. We're going to talk more about that, but to invest in Black and brown fund managers and founders with a focus on clean tech, health tech, fintech, and media.
All right. But first, it's time for VC Sunday School. Every Sunday we've been doing this, and you can go back into the archive, just look at the Sunday episodes to get this really just great combo. VC Sunday School, where we talk about different questions Molly has on her journey to become a legendary venture investor. And I look into my 11 years of experience and see if I can help her. Today, we're going to talk about these giant funds and the dynamics of these mega crossover funds, and I give a little bit of historical background on the Marc Andreessen blocking beef that I've had for the last decade. Stick with us.
I like how you call it a little bit of historical background and not like dish the dish.
No, it's like a little history.
It's a little tiny bit of tea. It's a tiny bit of tea. I did notice when we were recording this, some noties asking, if you go to our YouTube page, youtube.com/thisweekin, there is, in fact, a playlist of all of the This Week in Climate Startups and VC Sunday School segments, like all.
Perfect.
You could just binge it all.
You rip it.
One at a time. But today is going to be a great show.
And so, stick with us.
This Week in Startups is brought to you by Bubble. Bubble empowers people to design and launch their own apps, marketplaces, or tools without needing coding skills or pricey engineers. The first 500 listeners will get 1 month free on any of Bubble's paid plans, from $29 a month to $529 a month at bubble.io/twist. Coda is the all-in-one doc for teams. If you've got a stack of niche workflow tools, or if you get buried in docs and spreadsheets, Coda is the doc that brings it all together. Startups can get a $1,000 credit at coda.io/twist. And LinkedIn marketing. To redeem a free $100 LinkedIn ad credit and launch your first campaign, go to linkedin.com/thisweekinstartups.
Hey, everybody. It's Sunday. And you know what happens on Sunday? Molly has an extraordinary guest in the climate, sustainability space. Everybody looks forward to that. And then, as an extra appetizer before you get that great entree, we do VC Sunday School. This is where Molly, on her journey to become a legendary investor over the next decade, asks me, a legendary investor in his second decade, hey, I came across something. I got a question. None of the questions are bad questions, because what we do is kind of a dark art. It's alchemy. It's not something in capital allocation where there's a specific formula. If there was, there would be nobody doing it. There'd be an algorithm. And the market is dynamic. It changes constantly. So what did work as a technique in a down market might not work in an up market, and everything in between. So let's get to it.
Let's do it. And yes, by the way, I just want to remind you, all this content is free. Can you believe it?
Yes, that's the idea. All you have to do is listen to 3 ads per episode, which are under 75 seconds each. And all I ask is that you tweet or click the link and consider the sponsors who make all this content possible. You know, the team at This Week in Startups is now up to 9 people. 9 full-time people produce 6 shows a week. This thing's a juggernaut.
It is a juggernaut. I got a nice DM from a fellow investor the other day saying that that we are content machines. And he just was like, I don't even understand how you're putting out that much content and also like researching and diligencing and responsibly investing capital all at the same time. And I was like, producers and researchers, man, it's a magical
it's
system.
like
it's great
if
people.
You have Steph Curry and Klay Thompson and Draymond Green and you put up a lot of points and you win a lot of games and you have a 70-game winning season, there's a reason. You have talented people working on the team. We have 3 extraordinary producers, an extraordinary video editor, 2 extraordinary sales executives. And, you know, let's face it, 2 all-stars, you know, on the court, just hitting things from the logo. Okay, let's get started.
All right, let's do it. Okay, so VC Sunday School, I have a question for you about gigantic funds. I have been reading the textbook, The Business of Venture Capital. And one of the things it talks about, because that's why I say this is free, because it's like $57 that I spent on this book. But one of the things it pointed out.
Wait a second. Did you say it was $57 for this book?
Yeah, it's like a Wiley textbook.
Oh God.
You know.
Okay, great.
I take my learning very seriously.
All right, I like it.
But one thing that it noted that I thought was really interesting is that big funds are not necessarily better because big funds demand such big returns that they start to get unwieldy, that you run the risk of distorting the market in lots of different ways, not least of which is valuation and like how big you're pushing a company to get, even if it's not a good idea for a company to get that big. And I wondered how you thought about that. Like, are big funds not ideal?
Okay. So ideal for who is the question. So let's start there.
Right.
Most people think that a milestone-based funding environment is optimal, right? We've talked about this before. Yep. Somebody goes to friends and family, they raise 25 to 100K, they get an MVP going, and maybe they have somebody test the product, they get into an accelerator, they get 100, 150K, they do a seed round for $1 million or $2 million, they get a Series A for 3 to 10, and each step along the way, they prove some stuff, and if they don't prove stuff, then they get eliminated, they get cut. Just like a professional sports team, and that's why the two most apt metaphors for what we do in startup land, as maybe aggressive as they are, is a sports team and a war. Because it is a competition and there are winners and losers. So we'll put that aside if that's, sometimes it rubs people the wrong way that we use these metaphors, but it's a competition. And so is capitalism. And so if you believe in the milestone-based funding system as a device, well, then that would argue for appropriate sized funds along the way. You don't want to have a fund that makes 30 or 40 bets at $30 million, which means you've got $1 billion fund if you're doing Series A, because the Series A should be 5 to 10 million. And 10 million is probably what most Series A's are in today's environment, but they used to be 3 to 5. So if you're a seed fund, do you want to have a $300 million fund if you're doing, 100 names and it's 3 million? No, you need a $100 million or a $50 million fund so you can put 250 or 500 into these. So there's this appropriateness for the bet sizing. Now, why do people say 30 names, 100 names? Well, it's based on the number of winners at each stage. So in the earliest stage, you're going to say, hey, 1 out of 50 or 1 out of 100 might become a unicorn, and those would pay off 200, 500, 1,000 to 1. That economics makes your one investment return the whole fund. So you can have a lot of losers and 2 winners and still have a great fund. Then you look at the dynamics of a seed fund, or let's say a Series A fund. They need to have, of the 30 bets they make, maybe 3 winners that pay off 50 to 1. 3 winners pay off 50 to 1. You got 150 times your money. You get the idea. Yeah, everything starts to look pretty good. You made 30, 40 bets, but you got 150 times and have 1 bet back. Now you've got a 4x fund, 5x fund. This is kind of what you're shooting for as an outlier, is to get to that 4 or 5 times. So what happened was more people wanted access to venture capital. The word got out after Facebook, after Google, that this is like, you can't lose.
More people, meaning more investors, more LPs?
Yes. Yep. So more LPs were like, I want to give you more money. You made me money. I want to give you more. Will you take twice as much? Well, then Sequoia says, well, the fund's full up. We're not taking new LPs. I don't think Sequoia's taken a new LP in decades. And so the endowments are getting so big. If you look Harvard, Yale, like these things are growing like incredible. They have more money because equities are doing better. Nobody ever thought that these companies would hit $1 trillion or go global, or we've talked about many times in the show, Molly, like, wait, how did this company grow 30, 40% on this giant number, right? Yep. So it's a growth company, but it's a value stock at the same time. Whoa. So you have these dynamics that mean there's more money sitting around, dry powder. There's dead money sitting on the sidelines in bank accounts, in treasuries, in cash, in devices that don't have the return profile of venture, which is, hey, 20% a year, every year, as opposed to the stock market, which has performed historically at 7% a year, and bonds that perform under that massively, and cash performs nothing now. So because of those, meta kind of economic conditions, more money is chasing alpha. What is alpha? Alpha is like your increase versus that 7%. So if you put money in a money market account of just the index funds, the alpha is the difference, like how much more can you do on top of that? So if I could buy, the S&P and the NASDAQ and these index funds, can you beat that? Because why do I have you? Well, venture does beat that, right? And maybe hedge funds beat that. So this is all the sort of macro picture, which then led to more venture funds being launched because, well, if Sequoia can't take new LPs and those LPs want to put more money to work, well, then they're going to go down to the next tier or new fund managers. Then you have this other dynamic. Well, I'm a venture fund. I should do a growth fund because those bets are easy to make. Like betting on Facebook in year 6 or 5 was an easy bet. Uber in year 4 or 5 was an easy bet. So they had the growth funds. And they're like, oh my God, Y Combinator is really running the table, and Techstars is running the table, and JCal's running the table, AngelList is running the table on early stage investing. Let's start a seed fund. Let's start a Scouts program. We'll copy Sequoia there. So now they have multiple funds. So they're putting so much money to work. But your question was about these larger funds and fund optimization size. Well, the fund has to match the stage.
Yeah.
So creating a $1 billion accelerator or seed fund makes no sense. There's not enough companies.
Right.
So you start to
figure out. And they don't need as much money. You can't like shove their pockets full of cash. They can only manage 500,000 or $1 million or $1.5 million.
And you don't want people on a bicycle going 100 miles an hour, right? Like you don't want people on a surface street going 150 miles an hour. Like that's like track speed. And there's highway speed. And then there's like, your local neighborhood speed of 25 miles an hour. So going faster doesn't help because if you're trying to get product market fit and you got 100 million in the bank, you can't get product market fit with more than 10 people in a company because there's too many people around the table. It's not going to help find that little magic of making a great product when you're in the laboratory. Let me tell you about one of the original innovators in the no-code space, Bubble. As you know, Bubble empowers anyone to design and launch their own apps, marketplaces, tools, without doing any coding. You don't need any coding skills, and you don't need expensive engineers. No. Bubble's digital editor and cloud-hosted platform starts at just $29 a month, a bargain, and you can build almost anything on Bubble today. You can go from an idea to launching a product in just days or weeks, not months or quarters, or in some cases years. Bubble utilizes really simple drag and drop elements in their visual editor, and they handle all the boring stuff like deployment and hosting, so you can focus on what matters, the product and customers. That's what startups are all about. And that's what Bubble is going to help you focus on. Let me tell you a story. Seth Brown was one of our Founder University graduates. He took our 12-week course on building MVPs and building startups. He actually used Bubble to build and launch his own on-demand gift-giving marketplace. It's called Gifting. Giphtting. He told us that Bubble helped him grow Gifting's pre-launch community with no coding required. Bubble is offering 1 month free on any of their paid plans, ranging from just $29 a month all the way up to $529 a month. But act fast, because they're only offering this deal for the first 500 redemptions. Head to bubble.io/twist and snag one of these 500 coupons today. This is the issue. What it means is, would people, if they got lower returns, still be attractive? And the argument people are making now is, well, even if you return 15%, that's 7-8 points more than the average of the markets. Your alpha is 7-8%. And so I think that's how some of those, fund to funds, capital allocators, endowments are looking at this. Even if venture retreated a little bit and was closer to, the stock market returns, but a little bit better, at least we're getting into these great companies. And if some of the funds underperform and they do the same as the stock market, or they do half the stock market, and some of them do triple, I have to park the money somewhere.
Yeah.
And then there's another thing. Who's it good for? If you get management fees of 2.5% per year, it's $25 million on a $1 billion fund. And then you launch a $1 billion crypto fund. Now you got $50 million a year coming in. Now you do a $1 billion China fund. You do a $1 billion, pick another vertical, SaaS fund. Now you're doing a 500 million early stage fund. You start stacking these funds together, and all of a sudden, the management fees start overlapping. So you just have a lot of cash coming in, which then lets you build a huge organization. And then that lets you press your advantage, perhaps.
Right.
But there is going to become some point where your fund size is too big. Now, I think with Andreessen Horowitz, they bought Skype at some point and then flipped it, and I think they made $1 billion. So they doubled their investors' money, and would seem like that's a bad for a venture investment.
So they doubled their investors' money by basically by getting high on their own supply, kind of?
They just did an opportunistic deal to buy Skype, and I think it wound up getting sold to Microsoft or something. So they do this huge deal. They build it for 2 years. So they double the money, but they double the money in maybe 3 years. So when you do these later stage deals, because there's also this variable of time. So if you can make a $100 million bet and you only double your money, Well, that would seem to be terrible, right? Because we're trying to do 3, 4, 5 times cash on cash in 10 years. But if you double your money in 3, okay. That on a percentage basis is still pretty high. So the later stage funds theoretically return the money faster. But then weird things can happen, which is people start overpaying for startups. They start competing at such a crazy level, like we've seen with SaaS companies getting 75 times top line revenue or 100 times top line revenue, that when that retreats, all of a sudden you could be underwater, which is what just happened, right? So we could say it's no longer theoretical that these late stage funds could get ahead of their skis. They're now ahead of their skis. Yeah, we'll see if they catch up. What they said publicly was, we're just going to go earlier. So now that it's like, oh no.
Right. That's my follow-up question is that, yes, once you get to a stage where, look, there's only so much growth you can expect from companies. There's only so much you can return without having to do some kind of a move where you bail yourself out. Let's be honest. You do have then these funds trying to get earlier in different ways, like Tiger Global, for example. I mean, it just has to be the example of all of this hugeness, right? Tiger Global saying that they've committed $1 billion of their own money into a fund of funds to back seed funds to invest in earlier stage startups. So thinking of ways basically to spread their own capital around on behalf of their LPs. I mean, how crazy have things gotten when you now have this sort of multi-level cake?
Yeah. The way I would look at it is...
Or is it just about, to complete the follow-up, is that just about chasing bigger returns? Because you actually maybe have to go earlier in order to get the returns that will allow that fund to continue. I think
people, as I said at the beginning of my little monologue there, when we talk about advice for investing, the market is dynamic, and what worked last year may not work this year. So if last year making these bets or for the last 10 years, making late stage bets worked, and then suddenly this year, with the public market compression of multiples, these late stage deals don't work anymore. And there's indigestion at that stage where these companies kind of have to work through all this excessive capital and then catch up to their valuations. Well, now where are you going to put the money? Okay, so you're sitting at the money. You say, you know what? Maybe we should then go and try to deploy some capital a little bit earlier. Now, why would Tiger Global want to invest in seed funds like ours? They're not an investor in our last 3 funds, but who knows? Maybe they'll do our next one. Well, that would be for access. So it's a very savvy move. And we're seeing more and more of the late stage venture funds. We have 3 venture funds that are later stage or full service funds, I wouldn't say which, who are our LPs. So why would they want to build a relationship with us? They want to get downstream. We have 4 actually. They want to get downstream deal flow. If we happen to hit another Uber, we happen to hit another Com, they would love to be able to say, hey, can I get an intro? Or, hey, do you have pro rata that we can help fill with you and split the carry or something? So there are these kind of dynamics in the field. So for Tiger to go put money to work in those, that was something that Sequoia did a long time ago. They've been public about that. And also Marc Andreessen, who was in my first fund, Launch Fund 1. We had a falling out, so he's not in the next ones because he wouldn't come on the podcast. Crazy weird. But yeah, that was the fallout. I think I've talked about it publicly, but I was like, Marc, come on the pod, or speak at the event. This is when I was starting my career, and it would be really helpful if Marc Andreessen showed up, and he would show up for a Sarah Lacey event for Pando. He'd show up for TechCrunch. He'd show up for these ones. And I was like, can you show up for one of mine? And he's like, do I have to if we're going to be in business together? And I said, well, yeah, kind of. That's the idea. You help me build my career. I make early stage investments. You got a later stage fund.
Yeah.
And he was like, yeah, no. And I was like, okay, then I just kicked him out of my fund. Because I was like, and that's, that's why he blocked me. And then we went back and now he's unblocked me. Now he's a fan of the pod, whatever. Anyway, I don't want to accumulate enemies, but I just thought I had to take a stand for if Ruloff and Chamath and Sachs are coming to my pod, I'll just, and then I had a couple of founders I sent to him. He was really excited to meet them. And then he didn't show up for the meeting and he sent an associate. And that happened 3 times. And 2 times the associates at Andreessen or the younger partners were on their phones. The same complaint. And people flew in for those meetings. So then I emailed Marc and I emailed, Ben. And I was like, guys, if I send you somebody, would you at least meet with them? I'm a pretty good point guard here. When I send somebody to Ruloff or Chamath or Sachs, they actually meet with them. And you guys pawn it off to some associate. They fly in. Instead of it being an hour meeting, it's 32 minutes. And then the person is on their phone and they don't know why they're there. and I don't know the person, and so there's no context. And like when I had 3 founders out of 4 have a bad experience, I was like, well, there's no reason for me to send people to Andreessen Horowitz anymore.
Yeah.
So that's the backstory. I don't know if I've ever told it, but that was the backstory. It was like those 2 things was just like, Marc is too difficult to work with. I know, and that's coming from me. I'm a difficult person too. So I'm not.
It's like a pretty, high bar for.
Well, no, and then other people who I'm friends with, like David Ulovich, I'm a friend with over there. Chris Dixon and I are friendly. They're like, hey, how do we heal this? Like, how do we make this go forward? I was like, we don't. I'm never having anybody from Andreessen Horowitz on the pod until Marc Andreessen and Ben Horowitz come on the pod. They don't like me. If Ben Horowitz doesn't like me, and it's weird because his wife and he were really nice to me when they saw me at a Warriors game. So I was like, do you not remember that you guys were jerks to me? Or are you just like glossing over that? Silicon Valley is a very weird place. And Ben and Marc are kind of unique, weird individuals too. Very successful, and I kind of like them in some ways. But if founders are going to have a bad experience with them, and I send them to Roelof or Bill Gurley or Chamath or Sachs, and they have a great experience,
right?
It's a pretty easy decision for me. And I told them that. And then Marc was like, well, my fund runs differently, and I don't meet with founders. And I was like, okay, whatever, it's fine with me. Your loss.
Yeah.
But it's a very smart thing. Marc did a bunch of splashy cashy at some point and put like $50K into a bunch of different venture firms to build relationships like that in the early days of Andreessen Horowitz. So I think that's what Tiger is doing. They're taking the Sequoia and the Andreessen Horowitz or Marc Andreessen approach of, hey, let's just build some bridges here and steal their deal flow. And so that's the other thing. It's a competition here of relationships. Hey, let's talk about Coda. Last year I interviewed Coda CEO Shishir on episode 1160, and we spoke about the productivity renaissance that's going on in tech right now. And that's what Coda is all about. In Coda, your text and tables live together in the same document. And all your valuable data, plans, objectives, and strategies are all in one place, not in 5 different pieces of SaaS software. This helps any team collaborate more efficiently. I've got thousands of templates that you can work with, or you can take the playbooks published by some of the best innovators out there, and you can use them for yourself. For example, if you want to map out your OKRs the same way Pinterest does, it's right there waiting for you. You just read the page, you duplicate it, and you start using it. Coda works right out of the box, and it's all customizable, so you can create a wiki or a knowledge hub for your team. You can onboard new hires quickly and adapt fast to any major or minor changes in your business. What Coda can do is exciting, but what's even more exciting is what startups can do with Coda. So here's your call to action. Coda has an amazing program for startups to help optimize and support your docs. So if you go to coda.io/twist, you're going to get $1,000 in credits. They really want to invest in the startup community because they know there's so many great ideas there and they know they can be helpful with their software. So go to coda.io/twist to get that $1,000 credit.
I think that's a really good note, and things that people don't always realize is that that it is all about. In fact, I did not totally understand that until I started meeting with investors who were like, "Oh, I should introduce you to the growth fund people. Oh, this is a follow-on opportunity." That in fact, you're not just building your own portfolio; you're building a pipeline for those companies.
Yes,
and that the pipeline for those companies is not like entirely. It's milestone based, but it's also relationship based. It's who gets that call from you. Or
correct.
Who calls you?
Yes. So, somebody in our syndicate tells us, hey, J-Cal, I met with this company at like a pitch competition. Like I got one of those today. And I was like, oh, that's interesting. Great. I'll send it to our person who does SaaS. Let's see if it's a fit, and, that kind of deal flow helps us. Right. And so conversely, I send somebody to Sequoia or to Chamath or to Sachs or Freeberg or Bill Gurley. That could be very accretive to them as well. Mm-hmm. And so, this is why building relationships is so important in venture. So anytime you have a chance in your career to meet with a new fund manager, to have coffee, to do a quick Zoom, there's really no downside to that. And then if you want to build deal flow, and I talk about this in my book and I do it in the Angel University course, if you're not getting enough deal flow, just email 10 VCs who you're co-investors with. I call this my pop-up network strategy. Let's say we have 10 investors who invested in Calm with us. You could email them and say, hey, I know we're both of our firms are investors in Calm, and I'm looking at these 3 new companies. I just put a little blurb about each one below. If we're investing in these 3 companies, or we've invested in these 3 companies. If you wanted to meet the founder, let me know. 2 of them are raising, 1 isn't, but I have high conviction for them. And if you ever meet a company I'm really specializing in climate, sustainability, and my partner Kelly is doing SaaS, and my other partner is doing, consumer tech. Do introduce us. We'd love to meet with them. And now you do that 10 times, a month, and then in a year you've done it 120 times. And then if just 20% actually respond, got 25 people maybe emailing you companies. Yeah. And that's, you give a little, you get a little, it works.
I've noticed I have met with some investors who have purposefully cultivated that as a strategy. And I think it's genius. I've now have created a third tab in my to-do. So my to-do list is like twist. I mean, there's also like hopefully do some for your life, but you know, that doesn't always happen. But there's like twist, investing, and networking. Like I've literally created a to-do tab for that because it's not like it's not a significant part of every job on some level, but it is it's so specifically part of this job in a way that I don't think you can even though a million VCs have told me that over the years.
I'll give you the super tip. We should, now that like we're both had COVID and we're on the other side, we should just do a climate dinner.
We should do that.
Invite like 8 other climate investors, 6 other climate investors. We rent a private room at a restaurant. You bring 10 people. It costs $200 or $300 a person. We spend $2,000 or $3,000. We host. You sit at one end of the table. I sit at the other. We bring one more person from the firm, and we bring 7 other people. Yep. Now we have relationships. And that's really what it's based on. So anytime you want to do that, we just set it up for April or something and invite 7 climate, sustainability investors, maybe a founder. What's the power incubator in Oakland that the woman runs who's been on the pod twice?
Emily Kirsch
at Power something.
Powerhouse.
Okay. Mm-hmm. Yeah, like invite her.
Yeah, 100%.
She's got
my
some
homie Danny Kennedy, who was on early on. Yeah, exactly. We got Obvious. You could invite Saka.
That was my strategy early in my career as a journalist, as an entrepreneur, and then as an investor. I would always host a dinner at the E-Tech conference or All Things D. I would just get a reservation. I would typically do it at a Mexican place or a pizza place because I was broke. Mm-hmm. I would order food for the entire table. I tell the waiter, don't bring menus. Just start bringing these 17 appetizers, bring 2 things of sangria, or, open these 2 bottles of wine because people are it was like a doubly cool idea. 1, it made me look gracious.
Yep.
That the food just landed. 2, it saved me a ton of money. And then 3, everybody got to talk more because we didn't have this whole rigmarole with ordering and the specials and everything. So I could host, but now I'm baller, so I would just do it at like a really cool place, and not care about the money. But
I'm just adding this to my networking to-do list. By the way, I just put it in my tab.
It'd be like a great thing to do. I really want to get out and meet people. That. All right, listen, we talked for 25 minutes.
Anxious.
Yeah,
we're good.
I think we did a great job today. We gave a little bit of background on the battle between me and Marc Andreessen and the block and unblock thing. We got some good advice. We talked about the market. We talked about some strategies. I think this is like a yum 23-minute.
I know. I love this show. It's so great.
Hey, Tom Eschbacher is here with us again. He's a senior sales manager at LinkedIn Marketing Solutions. And we're talking about their amazing report today in startup marketing, as well as how to use LinkedIn to grow your startup as an angel investor. I like to see revenue early and often from startups. How can LinkedIn help with that?
Yeah, the short answer is LinkedIn lead gen forms. 89% of our startup advertisers utilize them. And I'll tell you why. Think about all the effort that goes into creating interest within a prospect. You have to nail the value proposition, create compelling content, find them, and then message them with enough frequency so that they engage. You do all that, you get them to your sign up page, and you know how many of them are going to convert? Just 2%. That's so much value that marketers are failing to capture. And it's a big reason why LinkedIn marketing and specifically LinkedIn lead gen forms are so popular with startups.
So people know a lead gen form lives on LinkedIn. They click one time and boom, the email is sent to the company.
By using LinkedIn lead gen forms, you're ensuring they're coming from an audience that you care about. And then we're pulling the information right from the member's profile. So it's great. Your SDRs are going to be thrilled with that info. They're going to want to follow up. That's the improved lead quality. And as you say, Jason, it all takes place in just 2 taps in the LinkedIn newsfeed.
And so if you would like to get this incredible report, you can go to linkedin.com/thisweekinstartups. And not only can you get the report for free, you're also going to get $100 off your first marketing campaign from Tom at LinkedIn. Way to go, Tom.
It gets even better because it is time for This Week in Climate Startups. And I talked with Taj Eldridge of Include Ventures. Such a fascinating person. So include Taj recently raised, he's both a first-time fund manager, actually, sort of. Like he just raised a $250 million fund that is a parallel structure. It's a fund of funds and also an investment vehicle to back specifically Black and brown fund managers and entrepreneurs around clean tech and climate justice and, general issues of equity. Such a fascinating founder, by the way. He said that when he was doing events in Riverside for Black and brown founders, you, Jason, were among the only, I believe, the first and maybe only VC to come down and do those events and visit those in person.
Yeah. I always like when people are doing something new and supportive as a general concept that's worked in my career. When I see somebody doing something new, like a new podcast comes out and they're like, I'm starting a new podcast. Will you be my first guest? And I'm just like, once in a while, I'm just like, sure. Then I regret it because I have like a crazy schedule. And my team is like, what are you doing? Why did you say yes? And I just feel like if you get lucky like I did, once in a while, would it kill you to just look at the ladder behind you and give somebody a hand to pull them up a couple of things? And at this point in my career, if I show up,
Marc Andreessen.
Well, yeah, exactly. Like this is the opposite. It's like this is the anti-Marc Andreessen. Like pay it forward a little bit and be a little supportive of other people. And it was just like, it doesn't really cost me an evening or something, which, is not inconsequential. But, like if you or I show up at something, it's meaningful, right? Yeah. Maybe not 20 years ago, they'd be like, who are those people? But today, maybe it is. And so I always like to be like, gentlemen, don't send me 100 requests to be on your pod. But I try to do it I try to do it once a month, like a student asks me for something. So maybe 12 times a year, 24 times a year. Yeah. I just try to say yes to something that takes an hour and it's efficient and I can help somebody. So anyway, there you have it. I can't wait for the interview. Let's get to
tuned.
it.
He's so good. Taj, Ahmad, Eldridge. Thanks so much for coming on.
Thank you, Molly. Thank you so much. It was great to be here.
This is, I don't know how I started following you on Twitter, but I've been like a Twitter fan of yours for a while. And then a mutual friend and colleague introduced us. And it's just like all magically coming together.
Absolutely. And I'm going to tell you, I've been a fan of yours for a while as well, from your days on Marketplace. And so I'm an economist by trade. And I love the way that you really kind of bring down a lot of the data and the things you're talking about. And I think that's, I call it the freakonomics phenomenon. And I love the way you do it.
Make it friendly all the time because it's the most important thing for everybody, pretty much. Yeah. Your Twitter handle is Econo Ahmad.
Yeah. I studied economics in graduate school, but ironically, in my undergrad degree, was in poetry and literature. As we were talking, getting everything set up, I was telling your colleague that I actually wanted to be a rapper when I was growing up, and my parents were saying, "Rap nothing, you're going to college." So I said, "I'll show you. I'll study poetry and literature." But nonetheless, I ended up, coming back to economics and realizing there's a piece of storytelling in economics as well. And 100%. Again, you talk about the same thing when you do your reporting.
Do you ever do any rapping on the side though?
No, but I hang out with a lot of rappers who are now getting into venture. So it's really interesting to see.
Huh. I mean, that's true. Actually, everybody's getting into venture. I guess it's just the money. It's the impression of the money falling from the sky.
Yeah. And I think also too, they're realizing that, music, the art form of making music is not as lucrative as it used to be. And then they're realizing the merchandising and product initially started out with clothing and merchandising, i.e. Yeezy and Wu-Tang Clan. And then they're realizing that other product, tech included, is really interesting and really getting to them. And now, which is even more interesting, is that a lot of them are getting into climate because they're realizing that it's the hot thing right now. And so, I think that's really exciting as well. Exactly.
Well, and on that note, actually, so, I mean, you have a fund, you're the GP and co-founder of Include Ventures, which consists of 2 funds and includes an emphasis on climate, right? Just give us the breakdown of these funds and how you operate them and your thesis overall. Absolutely.
So Include Ventures was started about in last year in June. And it's between myself and 2 other GPs. We have a team of 9 in LA and Northern California. And it's 2 funds. It's a fund of funds, $125 million fund of funds to invest in fund 1s, fund 2s, and fund 3s of climate, of GPs that are diverse and women and people of color. And then it's a direct investment vehicle to co-invest alongside with our funds, as well as make direct investments in the areas of climate, fintech, edtech, media, and digital health. The thing that we talk about, though, is that even though we're focusing on climate and those other sectors, I truly believe that all those things are interrelated. As an example, I mentioned ed tech or workforce is one of the things that we invest in. There's a company here in LA called Charger Help that's in the intersection between climate and workforce. On the fintech side, we talk about fintech. And for those that are in cryptocurrency, we know that there's a huge climate component or energy wasting component towards that. And so for us, there's a company called Etho Capital that's at the intersection of climate and ETFs. And so I truly believe that it's there. Even as we're talking now, I'm wearing my hat. A lot of people see me wearing hats all the time. And I do it purposefully because the hats that I wear are even made out of sustainable products. They're made out of waste products. And so I think that there's an intersection between climate and health, climate and fintech, climate and ed tech, and climate and media.
Without a doubt. We were talking before we started recording about how in the midst of, the war in Ukraine that's obviously taking everyone's attention, the IPCC recently released its latest report that I think may include the bluntest terms I've ever seen. They're saying that warming is baked in to some extent, that we can expect, I'm reading from the Associated Press, the world becoming sicker, hungrier, poorer, gloomier, and way more dangerous.
Absolutely.
There's an argument at this point that every investment is a climate investment.
Absolutely. It's similar to what I used to say about, I never understood how people separated impact investments from traditional investments, because for me, every investment you make has an impact. It will impact communities, it will impact people, it will impact the way that we do things, it even impact the language that we utilize. We're saying Googling and FedExing now for a reason. And I think that even from that report, what it made me think about, and the reason that we do what we do, is that we can't solve the climate crisis in a silo. Meaning that we can't have it to where the richer parts of our nation and our world are having the innovations and solutions and others don't. Even the position that we're in now, where all of us have to be virtual, it came from something that happened across the world that impacted the world. And that was horrendous. And it didn't matter how much returns you were having. It didn't matter none of that, because COVID decimated a lot of those things. The same thing is going to happen to climate. And I tell people all the time is that climate is nothing that's like we used to talk about things happening in 20, 30 years from now. But no, climate is a public health issue. I'm living proof of that. It's an economic issue, and it's a social justice issue beyond just our nation.
Do you want to tell us, do you feel comfortable telling us about how you're living proof of that?
Oh, absolutely. And I talk about this often. There have been a few GPs that have passed away. Tyson Clark from Google Ventures, who I know well, and Coyote Owens, but they had different diseases than I. But I was growing up in Dallas, Texas, and there was an area where I grew up where there was redline. And for those who don't know, redlining was a practice where you had people of color and African Americans, specifically in Texas, that were designated to a different area. But this area was an area that had lead poisoning in the ground. We didn't know that at the time. And two of my cousins, we all grew up in the same area. They've since passed away, one in their 20s and one in their 30s. And they had kidney disease and kidney failure. And when they got diagnosed, they were just saying, oh, you're African American, you're kidney disease, it comes par for the course. When I got sick about 4 years ago, I had the privilege of being in a position with the University of California, others, to really kind of do biopsy and other types of gene testing to figure out what this disease was. And as the disease was caused by the lead in the environment. And so for me, since 2018, I've been on dialysis. I go to 3 days a week, 3 a.m. in the morning to 9 a.m. so that way I can get and do the work. But every day that I wake up, it's a reminder of environmental racism that's here that really impact our communities. And for me, when I think about not just my disease, I think about people who may have asthma that live next to off-ramps in communities that look at the emissions from these trucks and logistics. As we're all sitting in our home ordering things from online and from Amazon, I have to think about that as well. So for me, it's a real life issue that I think that we could put capital towards. And I talk often that I may not be around for the result of this, and that's okay. But none of us will. We all will have the blessings to succumb. But I think at the end of the day, what I think about is the investments that I'm making is providing more than just a return from a capital standpoint, but it's really providing an extension of life. If we don't save people, we won't have people to work. We won't have people to buy products. So therefore, we're going to still have issues with how that impacts our investment. So I think everything comes hand in hand.
Yeah. And you have used that that approach, your approach to the world and to investing, to not only, as you described it to me, create a fund, but create an ecosystem with the fund of fund model.
Absolutely. Include is actually, in addition to the venture fund, we're a franchise actually. So it's 3 different parts to the company and that we own. So I mentioned Include Ventures, which is the 2 dual funds, 125 million fund of funds and 125 million direct investment vehicle. We also have VC Include, which is a training program. Think of it like an accelerator for fund managers. What we noticed is that even when I was going out and applied for things like the Kaufman Fellowship, it was pretty costly. It's $80,000 plus to be. And although there's some scholarships that allow for it, we felt like there was an opportunity to really provide funding and training for fund managers, especially fund ones and emerging fund managers. So VC Include was started with the support of UBS, MacArthur Foundation, Taj, and others to provide a free training program for emerging fund one managers. And so we graduated 14 fund managers last November, out in Berkeley, in many different areas. And there are really some great funds. And then in addition to that, the third part of our organization is Include Ventures, which has a number of former politicians that work with us as well as our directors of government. And from there, we partnered with organizations such as Hewlett Foundation to provide funding. And I'm so proud that we have announced, by the time people hear this, 10 climate funds that are led by diverse individuals in the U.S. and Europe that we're supporting to really continue to work on climate. And so those are funds such as the 22 Fund here in L.A., Tel Venture Partners in L.A., Supply Change that's focusing on food innovation, and then in Europe, funds such as Melanin Capital out of Germany, and Unconventional Ventures out of Sweden and the Nordics, which is doing really great work there as well.
That's so awesome. Like, it's awesome to see the interest and also the democratization. And I think that there is something to the idea that we're all so personally impacted by this, that it's not just about a career in finance.
Yeah.
I came to this from journalism because I wanted to have boots on the ground. Like, I sort of thought storytelling is great. It's incredibly valuable. I hope to continue doing it for the rest of my life, but also I don't have time to convince people.
Yeah.
We have to to get to work here because we have a profoundly personal stake.
Absolutely. I started my career as a banker, both as a commercial corporate banker with Wells Fargo and then in UBS Investment Bank. But I think in venture, it allowed for 2 things to happen. Number one, I can dress very well, like I do now. But number 2, it allows what I kind of call capital activism, because we can still provide returns. Because at the end of the day, we're investors, right? So we have to really kind of think about what are we doing and how the decisions that we're making that are providing our investors a return on their capital. But in addition to that, what I see is that the decisions that we make, the things that we invest in, they can really influence the future and the world after this. As a father, I think about that often, and I think about the future generation and the things that we're creating. And I think about what we will leave behind for the next generation as well, and the decisions that I make and how I invest.
Tell me about some of your focuses and your thesis, climate and culture. Under that, it sounds like there's energy, transportation, smart cities, Black and brown founders. Do you have specific filters?
Yeah.
Is it sort of like a feeling? Is it a little bit of both?
Yeah, no. So I think a few things. I think, I feel like fashion was my gateway drug to climate, because prior I wasn't. I'll be honest. I'll be very frank. And one of the things that people always tell me that I'm a little bit too transparent. So also here, but when I used to think about environmentalism, I used to think about crunchy granola. That was the term that we would say, like these tree huggers, people that do it. And I felt like there were so many other issues that I was facing in my life that I didn't have time to do that. There was so immediate issues. But that was before I really kind of delved in and saw that there was some immediate issues in climate that was happening to us as well. And so for me, I focus on the intimates. And I think that for us that are in climate, the problem that we've had is that, to your point about being a journalist and a storyteller, we have not told the right story to get more people interested in it. Mm-hmm. I think that it has to be public-private partnerships. Private capital, we can't solve the issue all alone. The public sector can't solve the issue all alone as well. We have to have collaborations, and we have to do it smartly. So for me, I focus on an investment in 2 things. Number one, what I call the intimates. That is things we put on our body and things we put inside of our body. So I really love the innovation that we see in materials not only just in fashion, but like, for example, there's a former NFL player named Sean Springs who's making a company out in Boston who was tired of all the concussions and decided to really kind of create a company that really did innovations on the helmet side. But then he started realizing that can carry into vehicles and auto crashes and everything else. And so those are the things I was really interested in. On the food side, we've been seeing a lot of food innovation, people changing their diet, making them live longer, a lot of biohacks. A lot of entertainers are getting into it. As an example, the rapper Drake is investing in a Santa Monica-based food innovation company. And so I think those have been really interesting. And then lastly, on the climate side, two things I'm also interested in as well, I think is really interesting is transportation. How we're looking at vehicles, the idea of the modern gas station is changing right before our eyes, and how people are looking at it is changing as well. And then lastly, energy management, especially for buildings. I'm at home right now. Many other people who may be listening to this are at home. How is energy being utilized at our homes? As we're making this transition and we're being here. I think also too, God willing, when we come out of this pandemic, you're going to have a lot of people who are going to do two things. They're going to think about, maybe I should continue to work from home part-time. That's a really great experience. And number two, you're going to see people that says, I don't think I need to live in San Francisco. I can do what I'm doing in Tulsa, Oklahoma. I can do what I'm doing in Memphis, Tennessee, and still run my company. And I think that really kind of influenced the way we created Include, because in addition to diversity, I often say that racial and gender diversity are important. What's even more important is geographic diversity, because I think that we're seeing founders and fund managers in many different areas. And that by itself is going to also talk to racial and gender diversity as well.
Yep. I want to go back to, you mentioned the moment when you went from this is tree hugger stuff to this is really profound to me. And it is my understanding that came about via wine.
Yeah. So
love this story already.
Yeah. One of the companies, I've been lucky to be an advisor and investor in a number of different companies, and a lot of things were really exciting about it. And I was first with a fashion company. And I must say, if any of your listeners are basketball fans, there was a moment to where the gentlemen who were playing basketball, they went from wearing baggy clothes to wearing really fitted suits. Well, that was the company, our company. That was the company that did it. And from that, we got into wine. At the time, I was talking to a couple of winemakers, and they were talking about, the wine was declining because at the time, craft beer was making the rise. You had a lot of people drinking craft beer, and spirits are spirits. Spirits were never go out of style. And so the community of wine was changing. And so one of the things we talked about was getting more young people, more people of color into wine. And the way we done it was from a standpoint of talking about pairing wine with fashion, film, and music. So it was a really great way to kind of push to that. But in that experience and talking to wine people, I started seeing a lot of the issues that we're having around droughts in growing the product, and just a lot of the complaints that we're having, and a lot how the climate was definitely impacting them directly. And I'll be honest, I never really thought about it like that. When I thought about climate, I always talked about, again, saving the animals, saving the trees and things of that nature. But I never really thought about how climate can have secondary and tertiary effects on many different industries, because the impact of wine impacted us in fashion and so forth and so on. And so I think that was kind of the first step for me to realize that, wow, like wine, climate is really impacting a lot of different things, and had me look at it differently. I think that really also impacted me to think about the way I talk about climate now, and to make it to where it's very plain. And I use the 8-to-80 rule when I talk about it. So if at least an 8-year-old or 80-year-old can really understand the issues, the solutions of what we're talking about.
Well, and I love the way that you're describing your filter for climate investments, because, last week we spoke with Andrew Beebe at Obvious, which is, I think in a lot of ways, I'm like so embarrassed about this pun, but in a lot of ways created some of the thinking around how non-obvious seeming investments are in fact climate investments. And that is not only a storytelling opportunity, but just something that people don't think about. We didn't necessarily think that meat replacement was a climate story, or that wine is ultimately a climate story and should be, that you can embed this in everything.
Yeah, a number of the SDGs really kind of point to food production and things of that nature, and how we look at
that. Sustainable Development Goals.
Oh yes, absolutely. I have to always remind myself, no acronym talking. It's the old banker in me. But yes,
so you're trying to save time.
Yeah, absolutely. But yeah, you're right. You're absolutely right. I think that is that. And I love Andrew, and he's definitely right on track with that. And I think when I say we, I'm talking about those of us are in climate. We have to do a better job of explaining that and really talking about the correlation and the relationship. And also, too, we have to not only talk about, I think we've talked so much about the doom and gloom about climate. We have to also talk about the opportunities, and so for me, I talk about the opportunities about job creation and how communities can really be developed with climate initiatives and things of that nature. I met a young entrepreneur out of Boston who's creating brownfields and old textile mills in Boston and in the cities of Boston, and partnering with those communities to create new types of innovation that are there. And so I think there's opportunities that we need to also coincide with the doom and gloom. Even I'm an economist, and like doom and gloom is our language, but I think we also need to talk about the benefits of it as well. And Andrew was absolutely right. There's absolutely a lot of correlations that we usually do. There were some investments in a company called Bevy that me and a number of other African-American investors made, including people like Baron Davis, Arlen Hamilton, and Kobe Fuller from Upfront. And Bevy is a company startup that mills the world of online and offline conferences. And so for me, the reason I said it was a climate focus for me is because when I think about the climate, the conferences that I've attended, I'm flying there, I'm driving there. That's a lot of greenhouse gas emissions that we're taking. And if you times how many people are coming, the opportunity to have online conferences does a few things. It democratizes information, because now if you don't have the ability to get to that conference or fly there, you can still get that information. That's why I love things like Upfront Summit and others that also do live streaming of their information and have people be able to connect. But also, again, it just creates a different way to have the conversation around climate and take the conversation away from, the talk on solar and a talk with a lot of other folks to get into more of a general type of conversation.
Yeah. This gets me to this debate that is happening, that became obvious as soon as I started talking to climate investors, and that kind of blew up about a week ago with Donnell Baird from Block Power, who I love so much. And I felt so upset when I saw him tweeting that basically all of these new climate tech VCs aren't helping, right? And we have, I will tell you, on every single episode of This Week in Climate Startups, I have asked every investor I've had on, what do you think about this question of software versus hardware, deep tech versus, emissions tracking? Like, what should we not waste time on? And I want to know how you feel about this question, especially since it really did become a pretty spirited Twitter debate.
Yeah, absolutely. I was, I think I commented there. Again, I'm the Kanye West of climate, so I try to not get in, but I totally agree with Donnell. And the reason for that is because prior to launching Include, I was at LACY, which is the Los Angeles Clean Tech Incubator. And from there, we have a prototype, et cetera. So hardware was in our pieces of it. And I think that to the point, you can solve both issues. You can have both tracking, but also solutions. But I do get angry when I see a lot of new climate funds come into the space where they only want to focus on software, and they only want to focus on tracking. And I'm like, tracking what? We have to have solutions. So I think the good thing about our industry and the good thing about venture is that there are enough climate focused funds out there that will support climate. We're happy that we're supporting Block Power and what he's doing as well. And there's others out there that are really doing some really great things as well. But I do think it's a conversation that needed to be had. And I'm glad that it came from the founder so that to make us as investors kind of think about it. But I think there's room for all. I think there's room for, I don't want to disparage investments in the software that might do some things on that end. And if there's a fund strategy, God bless them. But for us as Include and for some of the funds that we support, we definitely want to focus on the solutions, and we definitely are not afraid of hardware. There's an event that's coming up in April at LACY called Climate and Culture. We're getting more and more, Black and Latino VCs who are in this space, who are launching the funds to think about climate and not be afraid of hardware themselves. And the whole idea that we're trying to say is that to the point where we began, where we talked about the intersection of climate and all these other sectors, is that what we hope to see is that there will be funds that are making investment in a company that's a climate-based company, but they'll make that investment because it's a great company. It fits in their thesis. And I give you a perfect example. One of the companies that I was an investor in at LACY was a company called Ampere that we invested in at LACY, which is an electric airplane company. that has since been invested in or acquired by Surf Air. And there were some investors that we talked about it's an aviation company as opposed to a company that's building an EV that's reducing emissions for aviation. And so I think you'll start seeing a lot more of that, of funds that are getting into the space that are not necessarily climate. Tail Venture Partners is a perfect example that did a lot of software at the beginning, Black-owned climate fund. And then they fell in love with a founder by the name of Josh Aviv, who has a hardware company called Spark Charge, and ended up being an investor there. So I think you're going to see a lot more of that, especially from a lot of these emerging new funds that won't be afraid to make that leap, to make those investments in hardware companies.
Right. And they maybe don't have that sort of legacy concern exactly. They're just like, you know what, we're risky capital, and so we're here to take a risk.
Absolutely. We are venture capitalists, not, not, I don't want to disparage other capital, but we have to take measured risk. But at the end of the day, they are risk in what we're doing.
What about, though, Donnell's argument that a lot of climate investments are not amenable to venture scale returns?
We definitely had that conversation. And I think that, I used to be in the private equity industry prior to coming into venture. And I do think that there are different type of capital stacks that need to come. As a former banker, I'm proud that Darnell is one of those founders that have done it. And I tell founders all the time that sometimes debt is cheaper than equity. And so I think the debt market is going to be amenable to it and coming to it as well. I think we've seen a lot more private equity do project finance to go alongside of capital that's coming from the venture space. And of course, what Jigar Shah and stuff that those folks are doing at the federal government is going to help. But I think for the question what Darnell was talking about with infrastructure investing, and I think a VC was saying that too, that we don't necessarily focus on infrastructure or the infrastructure investment. I think that everything is related, but I think that there is an opportunity for different types of capital stack to come in. Even for us, as we were making investments in funds on our end, we made AUM investments or LP investments, but we also provided grants to those funds for management company grants. And the reason we did that is because we realized that as people are raising funds, even on the climate side, there are costs to running a fund, we all know. And either you independently wealthy, you're coming into it, or you've sold a company to try to do it. And so for us, we're providing grant funding to these climate investors so that way they can operationalize their fund and they can really kind of go to it and really build up. And so I think the same thing should happen is happening on the founder side as well. You're seeing a lot more grant funding. You're seeing a lot more different types of capital to come in to support and to prop up, especially early on, for those founders that are focusing on climate. So great things like Sierra Club is doing, series are kind of leading the way as well. So I think you're going to start seeing more of that. I'm actually speaking at Confluence Philanthropy next week about that very subject, about ways to really have partnerships with private capital, public capital, and foundations.
I'm glad that you said that, because it does seem like that there is opportunity for innovation there and sort of the different financial structures. I have also talked to a lot of companies who are taking some non-dilutive grant funding. I think maybe Breakthrough Energy has a fellowship program. I wonder if what we will also need, because I agree with you, I think everybody needs to be in the pool, right? And there are going to be some things that venture is perfect for and other things that venture is terrible for. Yeah. But I also wonder how we can maybe change our thinking about follow-on investment. Governments are buyers, right? What if they become the follow-on? Is there a way to make that model work that can incentivize everybody to sort of just keep moving? Because at the end of the day, keep moving capital.
Absolutely. I mean, that is the exact reason why. And I mentioned, if you recall, that we have the three parts of our company. Include Global, what's a company that was focusing on partnering with Hewlett to provide grants. One of the members of that company that we brought in was a former Congressman, Kwanzaa Hall, to have those conversations and to begin those conversations with his former colleagues in Congress to think about ways that we can really kind of be more attentive to this idea. And I think you're seeing a lot more. I think with the administration, you're seeing a lot more, especially the Department of Energy and others, you're seeing a lot more willingness to think about these things and to act upon it. I'm also proud when you're seeing things like the Department of Commerce that are getting into this space and saying, okay, how can we be helpful for the capital community within the country, and really kind of really focus on either providing capital or connecting with capital or exporting their ideas on what you're doing. So I definitely think that there is forward movement, but we have to be. I think these are the times now to really think boldly and to really kind of embrace new ideas and to not think about the status quo. And for me, I'll be very honest, I got into venture 20 years ago, and I'm so upset that we're still having the same conversations 20 years ago around race and gender in venture from when I got in. And so for me, what that tells me is that we need a changing of the guard. We need new types of thinkers that are in to really kind of move things forward, especially as we're talking about climate and these other focuses, because we may need a new type of paradigm to really kind of attack these issues. And we don't have time. We literally don't have time.
Yeah. I was thinking about that actually in terms of the 10-year horizon. There are all these complaints, and VCs say this all the time, right? That these solutions may not come to fruition in 10 years, or the 10-year timeline is too short for climate investments. And I thought, I'm sorry, 10 years is too long for a climate investment.
Absolutely.
Why would we be investing in anything that cannot come to fruition within 10 years? Because we are out of time.
Absolutely. And I think the founders, what I love when I talk to founders in climate is that they also see that and they want some solutions now. And I think for me, the reason why I'm very open and I talk about my own personal health and my stories, because I realize I don't have time. And so it makes me think about the investments that we make. It makes me think about the way I talk about what we're doing as a sense of immediacy. And you can make some great investments. And what I don't want, and I had a conversation with an investor that says, well, you'll make mistakes that are there. And I'm saying, that's the point of what we're going to do. I think what's interesting when I hear is that I've heard many stories about founders who have failed, and myself included, was when companies that failed ended up using that failure to accelerate other spaces and have a different type of outcome. And I think with this space is that we have to really kind of move forward on that end and ensure that we're funding these founders that can make these solutions and try these solutions that are coming out.
Do you think the guard is changing?
I do. I think it is changing. I'm happy to see that. I think when I talk about diversity, and I want people to think about it, it's not just bringing different type of races and genders in it. I think for me, it's about intellectual and experiential diversity. It's about people who are thinking about things differently. Like I mentioned, I didn't grow up in California. I didn't grow up in San Francisco. I grew up in Dallas, Texas, where venture was not, number one. But a lot of the issues that I brought with me, that I'm bringing to me as well, have been benefiting. I mentioned when we're starting on, even though I have graduate degrees in economics, my undergrad degree is in poetry and literature. So I understand this idea of storytelling and how to weave in a story as we're talking about the ways that we want to invest. And I think that those bits of diversity, both geographic diversity, intellectual diversity, experience diversity, are what's changing. And I think it's changing our industry for good.
I mean, certainly there is a time not very long ago when neither you or I would be having this conversation together as investors. Absolutely. Absolutely. And so from that very point, I think it is changing. And I think the next step of it is for us to have investors that are making some really great wins. For some, one of my portfolio companies in climate, what we talked about is not just an exit, which would be great, but also a solution. And one of the things we've been doing, well, me personally, a lot of the investments we've been talking about is that I've been less wanting to talk about, announcing from a press standpoint, raises and all sort of stuff. I want to talk about the solutions that they're providing. So as an example, and I'll use this as an example, one of the companies that we're in, Spark Charge, that I just mentioned, African-American owned startup company that's in the space of transportation. Instead of really announcing their raise, what they've been announcing lately is just the partnerships between Hertz. As Hertz builds up their EV fleet, this is a tool that they're using as well. Their partnership with Kia and others. And the reason why I love Kia is that I think that historically, when you start thinking about EVs, a lot of times people from different communities, economic communities, look at EVs as Teslas and Lucids that are so out of reach from a ownership standpoint. But when a vehicle OEM like Kia comes in that can make a car that's more affordable, it allows those individuals to participate. And I think a lot of people, just because they may be in an economic position, does not mean they don't care about sustainability. I think sustainability has been in immigrant communities and poor communities for years. We call it circular economy. Another community may call it wearing your cousin's clothes and rehashing the clothes over and over. So I think it's innate, but I think now we're providing those tools for them to do it. And those tools, again, if you come from those communities, you're going to have a little bit of leg up on what those communities needs, And so I think that's a huge part of the thing we have to do as well, is that one of the things, in addition to really kind of talk about from a capital standpoint and a public standpoint, the community has to be involved
in this space as well.
Yep, 100%. Taj, where can people find you?
Yeah. So number one, definitely, as you've mentioned, I'm on Twitter at Ahmad, and then LinkedIn. Definitely connect with me on LinkedIn. Love to do that, and I love to talk to people. I think for me as an investor, even though we're talking a lot now, I love listening and hearing people's arguments, just like you mentioned with Darnell. And I think it really kind of helps me kind of look from that. Yeah. I'm not on TikTok or Instagram, sadly, but definitely I'm a lover of words as opposed to lover of pictures. So definitely connect with me on Twitter.
I love it. Taj, thank you so much for coming on. I really appreciate it. And I hope we can work together for lots of years to come.
Absolutely, Molly. Thank you so much. Thank you this week. And it was a perfect opportunity to speak. Thank you.
Hey everyone, producer Nick here. I want to tell you about the SaaS Syndicate. If you're a founder of a SaaS company with a product in market, our investment team wants to talk to you. Head over to thesyndicate.com/SaaS, SaaS, to apply to raise from the SaaS Syndicate. And you can join Jason's syndicate of over 9,000 accredited investors at thesyndicate.com.
Producer Justin here. Know a cool startup? Check out openscouting.com, where anyone can refer a startup to our investment team here at launch. Even if you don't know the founder, if you're the first to flag a company for us and we decide to invest, you'll get $5K in cash or 10% of our carry.
Hey everybody, producer Rachel here. Are you an early stage startup that has product in market, some traction, and are looking to raise at least $500,000? Apply today to Remote Demo Day for your chance to pitch to over 9,000 investors in Jason's syndicate. Submit your application at remotedemoday.com. Our next event is on April 27th.
And if you want to learn how to invest in startups from the world's greatest angel investor, and no, we're not talking about Chris Sacca, then head to angel.university to apply. The 4-hour workshop costs $300 and all proceeds are donated to charity. To date, we've donated over $175,000 to various charities, and you can see the full list at angel.university/charity.